Welcome back to another episode with ByrdAdatto. As you can see, we are all still quarantined here in the Dallas, Texas area. Lots of fun and family time. But there's a lot of things that have been happening, and because of that, we want to bring different people in, have different voices. And Michael, we have another guest today.
Yes, today is our partner Jim Stanford, and Jim has been practicing with me his entire career and most of my career. He is a definite OG. We've all been together since the early to mid 2000s. What I think is interesting is we're talking about so many of our clients going to get some form of lending right now is that Jim has a background that leads our M&A group. And in conjunction with that, Jim ends up writing debt instruments and negotiating debt instruments with banks all the time. And in fact, many times on more complex deals has been hired by the banks to write debt instruments. And so, Jessica provided some real practical advice yesterday on yesterday's video, and Jim may just have a few tidbits or a perspective that are things to watch out for as it relates to, the traps in the documents that our clients will be signing.
Yeah, and I think that's a great point. Is we've had two prior videos with our partner Jay Riera before that on the need to manage your cash flow, and how to work with that. And then Jessica went further on about working capital and how to go work through that process. But now we're going to kind of get in the nuts and bolts of it, and that's where I think Jim is going to be able to really help everyone think through this process, which is, once I do get to the point where I do need to go get a loan, there are certain traps in every single loan document, no matter if it's a commercial loan or a line of credit or going through the SBA, that you at least need to be thoughtful on and make sure we always say, have eyes wide open, understand what you're getting yourself into. And so we thought Jim would be a great person to bring along, and maybe Jim, you can start kind of stepping in and start talking about some of those traps that you see typically in a loan document.
Yeah, sounds good. So, I think what I've seen in my experience a lot of times is our clients who are on the borrowing end tend to just focus on a couple big principal terms that I think everybody really focuses on. How much money do I need? Am I getting that loan amount? What's the interest rate and what are the repayment terms? Is a monthly payment within the budget that I think works, and does the interest rate seem reasonable? And what's the final maturity date? Once that's kind of comfortable with the client or the borrower, they kind of ignore the sometimes fairly lengthy loan documents that are just filled with boilerplate type language, and can have quite a few traps in them that turn out to be very problematic in the future. For example, is there a prepayment penalty? And if there is, what is that? And you definitely want to be aware of it. And is it something you're willing to pay if you need to refinance or get out of the loan? That can make one loan be very unfavorable compared to another, even though it seemed it had better base principal terms. If for whatever reason you need to get out of it, it could cost you more than you expected. Another type of clause that can be problematic and maybe not so frequently used, but it's definitely one that I do not like to see in any loan document, and it's an insecurity clause. And essentially, that's a clause that says if the bank feels insecure about your ability to repay, even though you've been timely on every payment, you haven't breached the loan documents, but they just feel insecure about your ability to repay, they can put you in default. And I personally think that's one of the most ridiculous clauses out there, but you'll find it fairly often in loan documents. And it's something that you should definitely try to negotiate out of the deal before you sign the loan. Other areas you want to look at is there a grace period? Because, in any situation, you could accidentally forget to send in the payment, be a few days late. And that happens with all sorts of companies, all sorts of bills, regardless if there's some catastrophic situation going on or not. And so there should be some reasonable 5-day grace period, and that's something you want to try to get in your documents. Cure period, you should have a notice and cure period that's a reasonable amount of time, at least 10 to 20 days, if not 30 on non-monetary type defaults. But other traps to think about are what are the negative covenants and restrictive covenants that you have, such as you can't have a change of control. Also personally guaranteeing the loan, what's the collateral that they're requiring? And the way this can get you in trouble is, let's say you've got a loan with a high prepayment penalty, as well as a clause that says you can't have a change in control. You are entering into a transaction where you need to restructure bring in some new owners. Well, unfortunately, you most likely would have to get consent from the bank to waive some of their clauses, or you're going to have to refinance. And when you go to refinance, you find you have this ridiculous prepayment penalty that could kill the deal. And we've actually experienced that with our clients before. But those are just real high level of some of the things you want to watch out for. The key is to definitely not ignore the fine print because it can hurt you.
And so on top of that, Jim, I know that there's been a lot of stuff out there that our clients are calling us about with the new laws that are being passed and I know Jessica's talked at length about that, but have you had a chance at all to look at the CARES Act at all? That's currently, as we speak, shooting this video, has not passed the House.
Yeah, I have been trying to keep up with it, and it's been changing. Fortunately, it unanimously passed the Senate last night around midnight, I believe, with 96 votes in favor of it. My understanding is that it's going to provide for $500 billion in relief for liquidity to mid-sized small businesses. It's going to go through the SBA program for that aspect of it, at least the small business side. It's different. The SBA currently has an economic disaster recovery program. My understanding is that you can't do both loans. You would have to do one or the other. The terms that are proposed in the new bill that hopefully will pass the House today seem to be more favorable than taking a disaster recovery loan out, which still is going to have a lot of the same SBA requirements of personal guarantee and things like that. But it's all still in motion right now, and we'll just have to see what's passed. And you definitely want to watch it closely. Once it's passed, I think every business in this country, medium to small, almost certainly has been severely impacted by this, and we all need liquidity, and this is going to be a great resource potentially to look at, and whether it's the economic disaster recovery loan route or the CARES Act route. We're waiting to see what comes out to see which way we best go.
Michael, do you have any closing thoughts?
Yeah, no, I mean, I think that waiting to see which one is prudent between the CARES Act and the SBA, and what strikes me is so many of our small business clients. I mean, these are going to be really favorable loans. I'm particularly drawn towards the CARES Act loan if it comes through like it's saying it will. And for many of our clients who want to just get back to running their business, and that's what their future is running the business, it's probably going to be a no-brainer. Still needing to look through some of these clauses, I would encourage our clients who have a more aggressive vision to grow and potentially bring in new owners or have an exit scenario where they sell their business, to really look closely at this and make sure you don't fall into one of the traps that Jim mentioned.
Totally agree with that. Well, Jim, appreciate you coming out and joining us today virtually, obviously, since we're in quarantine. But thanks for joining us. Michael, thank you.
Thank you. Yeah, thanks.
And that's all we have for today. So we look forward to you at the next episode.